10 Rules for Investing During a Recession. According to Bank of England, the cost of living crisis will push the UK into a recession in the coming months. While we are not currently in a downturn, there are some tricks to investing in one, so you should be prepared if the economy begins to trend in that direction. What is a recession? A country is said to be in recession if GDP, the total value of all goods and services produced in the UK, has fallen for 2 quarters in a row. GDP increased by 0.2% between April and June, indicating that we are not yet in a recession. The economy, however, contracted by 0.3% in August, and the Bank of England was warned that the GDP will contract further in the final 3 months of the year and throughout 2023. As a result of the pandemic, the UK economy experienced its worst recession on record, with GDP shrinking by more than 20% between April and June 2020. This is due to the government restrictions imposed at the start of the pandemic, which caused business to close and millions of workers to go on furlough. This resulted in sharp drops in services, production, and construction. Prior to that, the UK experienced a recession from 2008 to 2009 as a result of banking crisis and financial crisis. It was 5 quarters long, or 15 months. What does a recession imply for my finances? A recession can be devastating, affecting our earnings and employment. We explained how a recession can affect you and how you can protect your finances. Investors should brace themselves for a bumpy ride. However, even during a recession, the stock market continues to provide the best opportunity for long-term wealth growth. 1. Don't panic. When markets are falling, it's best to avoid rash decisions like selling investments, depending on how much you paid for them. You could incur significant losses by selling and potentially missing out on a recovery. The uncertainty surrounding the cost of living crisis will continue to cause market volatility, so the key is to focus on long-term goals while waiting for markets to ride out the inevitable bumps. 2. Risk should be spread and diversified. Diversification is an essential component of any investment strategy. Keep a mix of stocks and bonds. Spread your exposure across global markets as well, so you are not overly exposed to downturns in any one area. Make sure you're happy with your risk profile. This is the extent of which you're willing to see some investments lose value in pursuit of higher returns. 3. Maintain a low-cost structure. Fees for managing your money are charged by all investment platforms. Fees for holding funds are common, as are fees for trading funds and shares. Make sure you're not overpaying for your investments. Platform costs vary, so you could save money by switching to a better value platform, increasing the value of your fund. 4. Pour money into investments gradually. It is extremely difficult to time the market, which is when you try to buy or sell investments at precisely the right time in anticipation of price changes. It is even more difficult in a market marked by investors' fear and increased volatility. Instead, make saving a habit and gradually add money to it. You will then benefit from pound cost averaging. This is where you buy more units when prices are low and less when prices are high, implying that price averages out. 5. Make sound investment decisions. When investing directly in stocks, look for companies with strong balance sheets and business models. Companies where demand for the product or service is relatively insensitive to the economic cycle, such as supermarkets that provide consumer staples, are ideal. You may want to invest in industries that will thrive regardless of the investment climate. 6. Take advantage of low-cost stocks. Investment stock prices may remain low in the face of bleak economic outlook. This implies that you may be a good opportunity to purchase stocks at a discount. Some fund managers focus on finding undervalued companies that will thrive in the future. These include high-quality firms in industries that have been affected by lockdown but can weather the storm. 7. Be patient while waiting for dividends. Turning to stocks for income isn't as simple as it once was, but investors aren't out of luck. Even in cases where companies have reduced or ceased payments, dividends are likely to be reinstated in the future. Finding good dividend stocks entails looking for companies that have no debt and plenty of cash on hand. 8. Seek out safety nets. Many investors may be considering increasing their holdings or corporate bonds as a hedge against volatile stock markets. This is where investors are compensated with interest for lending money to businesses. Other than that, Gold is regulated as a reliable store of value during difficult times due to its independence from the stock market. Bonds and precious metals can help diversify a portfolio, ensure that your investments are not solely dependent on performance of the FTSE 100 or the S&P 500. 9. Invest in a prepackaged portfolio. Many fund supermarkets provide ready-made portfolios that aim to include a diverse range of investments, including non-stock market assets such as bonds and real estate. Many are labeled based on your risk tolerance. As there is no standard definition of what a balanced or cautious portfolio means, make sure you are comfortable with your chosen risk category. Find out which one was recommended if you're looking to a pre-made investment portfolio. You could also choose a multi-asset fund with a dedicated fund manager that guarantees diversification. 10. Take solace in the past. Economic downturns do not last indefinitely. If you have a 5-year or longer investment horizon, you should be able to benefit from the market recovery. According to Barclays Equity Gilt Study, shares have outperformed cash deposits in 76% of all 5-year periods since 1899.